All right, I'm going to let each of these guys introduce themselves, and then we'll dive right into our questions.
My name's Nick Hansen. I'm the CEO of Luxor Technology. We're known for building Bitcoin mining pools, but we build all sorts of other things related to Bitcoin mining software services, but we don't actually run any machines. So we're like a miner, but not really a miner. We don't actually have any infrastructure, but provide all the software and services for them.
I'm Larry Kom. I'm the CTO of Core Scientific. I got my start doing high-risk financial systems, securing them. I then created Honeyminer, and then pivoted into Core Scientific, where I build the hardware, the firmware, and work with partners like this.
I'm Adam Sullivan. I'm the CEO of Core Scientific. We're one of the largest Bitcoin mining companies. We own, are operating today about 745 megawatts of infrastructure, which is the largest infrastructure fleet of any publicly traded mining company today.
So today's panel, we're going to be talking a little bit about Bitcoin mining technology, how it's changed over the years, and more specifically, what's going on now and into the future. I'm going to start by a few easy questions, then we're going to dive into some details, and we get a little chance, we'll have some Q&A at the end as well. Okay, so, and this is for any of you to start with. So what have we learned about Bitcoin miners now that we are in the fifth Bitcoin mining epoch? We just had our fifth halving event, and what have we learned? How is it different from in the past, or what have we learned over the years?
Yeah, I mean, mining's changed dramatically, especially in North America over the course of the past, really, 4 years. I mean, you go back to 2020, we had no institutional Bitcoin mining in North America. You go back to before that, 2019, 2018, really the only institutional scale Bitcoin mining was actually in China at the time. And so what we're seeing going into this, or what we saw going into this next halving, is we probably have between 30 to 40% of all Bitcoin mining here in North America. And it's really a different game for publicly traded Bitcoin mining companies. You know, what we're seeing is actually publicly traded Bitcoin miners have actually decreased their percentage of the network over time. And that's really because what we're seeing is a decentralization of mining. This is not only happening on a company level, but it's also happening globally. And so we're seeing a lot more countries. We must have Bitcoin mining in nearly every country in the planet. And so that's something that is completely different than what we saw 4 years ago. And it's going to be something that you're going to continue to see going into 2028 and the next halving.
Yeah, so I think you can break down each of the epochs kind of into general categories. The first one is just general asymmetry, information asymmetry. I know about Bitcoin and you don't, so I can mine it with my laptop or a basic computer. And then we saw the transition to GPUs. So that would have been pretty much the second epoch, would have been, folks figured out how to start running SHA-256 on GPUs. And then that started the transition into ASICs, which are the mining machines that we actually have today. That would have been, probably the third epoch. Around that time is when we saw a rapid improvement in machines. You were having to turn over machines maybe every 6 months to close to a year. And so, you went from like the S1, the S3, the S5, all very, very quickly. And that was just, they were basically improving the efficiency of the machines really, really quickly. The last epoch was really about the institutionalization of mining, where more and more miners started getting huge scale. And then the inventory turnover was significantly lower, or at least the tenor was longer. So you would get, say, 6 years out of a machine instead of a year or less than that. And now we're getting into this epoch, which is really about the energy synergies. So you're starting to see miners participating at such scale where they're actually having an impact on the grid. And that means, so now they're actually having to work with the grid, work with the power providers directly, which is going to be this epoch. I believe that'll be the story for the next 4 years.
I think also what's happened is that we've transitioned from, at each stage, the technology may have started primitive, we might have evolved at each point, but at this current era, we have to optimize more than anyone's had to. The new technology is a higher quality, it's leveled the playing field, everybody's starting with really good components, and now what we have to do is we have to find that edge. We have to find the way that we can adapt to the environment, and that's for every specific environment that we operate in.
Okay, what are major challenges and opportunities facing Bitcoin miners?
So the biggest challenge to Bitcoin miners is other Bitcoin miners. The difficulty continues to increase. It seems like there's effectively infinite hash rate at some scale. We're continuing to see hash rate grow even after the halving, which is wild. You would have expected a pretty big drop. I guess there was a bit of a drop, but definitely not as precipitous as folks would have had expected. So the challenges for miners today is just like, how do I get that edge against everybody else that I'm competing with? How do I keep my machines on? How do I make more money than all the competition that are trying to do the exact same thing? It's literally the most pure competitive sport out there.
Yeah, I mean, right now, I think the biggest change that we're going to see over the course of the next few years, especially the next 4 years, is it's not necessarily a race to the bottom in power prices. It's really a race to how good people can actually be at scale. And it's not just at a single facility. It's how good can you be managing a number of facilities. So how do you manage 20 facilities or 30 facilities? And that's really going to be the difference that we're going to see in a shift. Because right now, the story for the last 4 years has been mega sites. Well, the mega site thesis is it's not dead, but it's not where the growth in mining is going to come from. People are going to have to continue to find an edge in power, in locations, and so that's something that the larger companies are going to have to find their edge in firmware, in operations, and actually figure out how to manage large-scale deployments across a number of different sites.
Thanks. All right, this is a good question for you guys. What technology developments are underway that will increase mining productivity, efficiency, and profitability?
Yeah, I think, the technology being developed right now, there's certainly higher class of miner. There's better heat dissipation. We've already seen the uptick in quality across all the brands. From that point, how do you optimize the hardware further? That's through more or less custom firmware. Now, each group has their own flavor of it, but we're all starting with the same equipment. We have to look at the variables that are available, whether that's ambient temperature or that's the quality of the silicon in that particular unit, and we have to get the most out of that. And I think as you see more and more groups getting into the space that want to provide that optimized edge, there's a group of sharing that's happening. People are seeing, well, they did it this way, they did it that way. And the quality, again, of the silicon is really the driver. How much heat does it take? How much voltage was required? And figuring that out for yourself, figuring out what you've actually acquired is something that we work hard on, but everyone is figuring out.
Yeah, so he mentioned firmware. Luxor builds a firmware product called LuxOS. I like to call it's kind of like jailbreaking your iPhone. If you ever had to do that back when you couldn't get your AT&T iPhone onto T-Mobile, it's kind of like that. Unlocks the full feature set of the machine and just gives it a lot more configurability. And that's what LuxOS tries to do, and all these other firmware providers try to do. Really, what you're trying to do with firmware is find the optimal operating condition for a particular machine, and that changes from machine to machine. Larry was kind of referencing something called binning, so like each chip is very different. Even though the chip they're all manufactured identically, just due to the nature of silicon, they're slightly different. Some chips are a little more efficient, less efficient, that sort of thing. So having custom firmware and having the ability to do that gives you a lot of dynamism. We call it, shout out to Guzman at the Luxor team. He's been working on something called the Intelligent Miner. It's basically a program that integrates with your power control system and helps you control your machines based on the inputs from the power from the grid. So, for example, in Texas, the power price changes from minute to minute. Actually, I think it changes every 15 seconds. That means that your machines today, right now, have different operating conditions than in another hour. Right now, power price probably somewhere in the $40 to $50 per megawatt range. But at the end of the day, when everybody goes home and turns on the air conditioner, that power price spikes to $400 or $500 a megawatt hour. During that time, you want to come down. They call it curtailment, but there's much more than you can do than just curtail. You can actually improve the efficiency of the machines as they're ramping down, as those power prices are ramping up. You start to slowly ramp the machines down until eventually they reach a point where it's best to just turn them off. This is the type of stuff that really sophisticated Bitcoin miners are doing, especially in Texas, where you have those free-floating power prices.
And I think also it is important to note that every single machine has to have a different profile. And so this is a reflexive, almost a breathing apparatus where the equipment, some is coming down, some is coming up. and it's paying attention to all the variables when it's doing that.
How are mining equipment suppliers addressing emerging needs for power responsive capabilities such as, this is a good leading question, that last one. How are mining equipment suppliers addressing emerging needs for power responsive capabilities such as different power modes? And I'm going to add in not just your manufacturers that are mega machines, but how are our miners also responding to that?
The way that the grid, and there are various grids across the country, the way that they operate is that they have supply and they have demand. And as those paths cross, it causes you to put in different power modes for your equipment. Normally, at a large-scale manufacturing facility, you wouldn't be able to bring down the power that quickly. It might be a spinning load. Whereas with mining, depending on how well you construct your firmware and how careful you are with your tuning, you can move that very quickly in a matter of seconds. And we're talking about megawatts at a time that can be brought down or brought back up. And at each machine, they have different tolerances for how well they can do that and can they recover back to their original state. And what we have done, certainly at Core Scientific, we have adapted that technology directly into the grid. So we run the same SCADA systems that you'd see at an industrial operation. And as the signals come in, we move that power around for that purpose.
So how many megawatts do you think this building uses? Maybe 2?
Yeah.
Around 2, maybe 2. So the scale of Bitcoin mining is pretty wild. Like this entire building is about 2 megawatts. These guys run 745.
Yep.
So imagine trying to manage that amount of power. Those are the type of systems that we're building. The tools and the underpinnings for managing that type of load. The Bitcoin network is maybe 12 to 13 gigawatts, so 12 to 13,000 megawatts. And it's always like I love the way you said it's kind of a breathing apparatus. It's kind of continually changing based on global economics, the way the mining, way the power prices change over time. Another good example was when natural gas spiked at the end of 22. That was a really wild time in mining because now your power price around the world has gone up significantly. And we actually saw hash rate drop a bit during that time, or at least hash rate growth slowed down during that time as a result.
Yeah, I mean, this is something where over time you're going to continue to see mining companies actually have a fleet of different power structures amongst their facilities. So you're going to see people that have, I would say, higher uptime facilities, maybe it's a little bit higher power costs, and that's going to work its way down as you go down in your efficiency to facilities that maybe are running 50%, 60%, or 70% uptime. One of the things we were just discussing was, you're mining out in West Texas or really anywhere in ERCOT, and that's something that you have to be able to be very responsive. It's kind of like mining in Arrakis, right? You don't have a great, you have temperature fluctuations, you have the power grid, you have all these different variables that are coming into play. And if you can sort out mining well in Texas, you can really go to any type of jurisdiction and be one of the best mining companies there. And so what we're going to see over time are companies with facilities that run the full spectrum of power contracts, and that's going to allow people to actually elongate the life cycle of a machine. So take a machine that would normally last maybe 2 or 3 years in a certain jurisdiction, take that to 4 or 5 or even 6 years, and run actually multiple power strategies within a single portfolio. And that's going to maximize every dollar that you spend to buy a new machine, because you're going to be able to say, this is going to have a useful life of 5 years, maybe 6 years in my facility.
Good answers, guys. Okay, what is being done to reduce miner CapEx refresh cost?
What was the question?
What is being done to reduce miner CapEx refresh costs? Or I should say, what are we seeing as miner refresh CapEx costs during this epoch versus, say, after the last halving?
Yeah, it actually goes into what I was just discussing. So the miner refresh at this most recent halving was different than what we saw in 2020. Going into 2020, you had a big bifurcation between S9s and the S17s that were coming out. And so at the last halving, there was this big concern that every miner was going to have to refresh at essentially the same time. That caused dollars per terahash, or essentially your CapEx cost, to increase significantly. And what we're seeing and what we saw going into April of this year was something that looked much different. The machines across the network were generally within a band of efficiency that could be altered based on a lot of the firmware that's being developed across the industry. And so you can actually bring that efficiency down, or I should say, make a machine more efficient. and still be incredibly competitive. And so what that meant for the time period we're now is price per terahash didn't spike post-halving on the newest generation machines. We saw price per terahash really across all of the machines decrease, and that's something where it was not just seen in the older generation units, it was also seen in the newest generation unit, which is not something that you necessarily would have expected to see. And that really stems from the fact that everyone doesn't have to go through this massive refresh cycle at this halving. And so what we're seeing, and what in our portfolio, we're still refreshing machines, but we're actually able to take older generation units and bring them up to efficiency levels of maybe the T-1 generation, or maybe even the newest generation unit. And that's something that wasn't really available in 2020. And so the dynamics of this industry in terms of buying machines has changed significantly over the past 4 years.
So the S9 that was kind of the workhorse that we talked about. The S9 is really what built Bitcoin and what it is today. An S9 was over 100 joules per terahash. That's the efficiency metric that we use. Today there's the prototypical machine. It's called an S19J Pro. J Pros are somewhere around 30, but with custom firmware, you can get them into the low 20s, mid to low 20s at efficiency. Obviously, you do lose some hash rate as a result of that, but hey, you're able to keep the machines online and producing. And so, like you said, we're continuing to see that the bands are getting tighter. The latest prototype model, the highest efficiency machine, is called an S21 Pro. It's around 15 joules per terahash. Reportedly, I don't think we've seen one in the wild yet. But yeah, we're getting, the bands are getting quite tight now, where if you can squeeze out a few percent from a different, from a particular machine generation, you can actually use those machines and compete effectively with, with the latest gen, which in turn extends the life and reduces your CapEx refresh cycle.
It's a loaded question. Is BTC mining only for large-scale operators now?
I could take the first crack at that one. Absolutely not. So it's interesting. We went from, you go back to 2011, 2012, people mining off of literally their computers. And then as we started to move forward, you went to GPUs, really jumped straight into ASICs. And even back then, it was, at most 5 megawatt deployments. There started to be some larger ones in China in 2016, 2017. And then really, I think where we saw kind of the peak of institutional mining was probably 2 years ago or 3 years ago, when large institutions were coming into the space. Now what we're seeing today is actually, I would say, the re-decentralization of mining. We've seen publicly traded Bitcoin miners go from 30% of the network down to 20%, and that's a number that continues to decrease. And so what we're seeing is actually a push to smaller sites, more decentralized across the globe. And these are small operators. They're running 1 megawatt, 2 megawatt facilities, but that starts to add up when you start to add in every country across the globe building multiple facilities like that. And so at least what I believe is, as we continue to move towards 2028 and the next halving, this is something where people are going to be finding these small opportunities on the power side to actually buy machines and actually be a bigger part of the network. And so I think what we're seeing today is the re-decentralization of Bitcoin mining. And I think it's great for the network. The decentralization is, that's in Bitcoin's ethos. So I think this is actually one of the more positive signs that we're seeing for Bitcoin mining right now.
And also, I think the tools that that were only available to those that built them, they're becoming more available for the whole community. You can pick up a miner and you can optimize it yourself, and you can start operating these in small scale again. And that was very hard to do, in the mid-gen era, where the equipment was costly, and you weren't able to squeeze that extra bit of life out of it. But now, through the great community of Bitcoin and the democratization of all that technology, more people can get involved as well.
Yeah, Adam talked about the decentralization of the network. The sun, I say energy is sparse. There are obviously density pockets, but generally the sun hits all corners of the earth relatively equally. So that means energy is generally distributed equally around the planet. All the energy that we have here today at some point was captured from the sun. So since the sun hits the planet pretty equally around the world, there is sparse energy. There's energy in all corners of the world. It's just how do you capture it? And we're getting more and more efficient as a civilization in capturing energy around the world. And so we continue to see places where energy is much more abundant, much cheaper, popping up continuously. Obviously, if you go to a power-dense region like Texas and turn on, what is it? I think there's around 3 gigawatts, 3,000 megawatts of mining capacity here in Texas. That starts to have an effect on pricing, which brings, let's say that brings some of the energy pricing up in Texas. So then folks start looking elsewhere. They start going to Kentucky. They start going to Canada. They start going to Oklahoma. So we continue to see, that happen where over time, you see pockets of density, but then that becomes saturated, and then it, diversifies out of there.
It's great answers, guys. And I'm going to add one more thing too. I know I'm the moderator, but just along the same vein with the decentralization part, you're seeing countries around the world realize the benefit of having Bitcoin mining on their utility grid. And what happened was we were with CPUs, then GPUs, then ASICs. We were centralized in China, then that moved a lot to North America, and then people started seeing the opportunity of having Bitcoin miners on the grid, and you're now literally seeing a global population of Bitcoin mining popping up all around the planet, where utility grids have excess power, and they're using that excess power to recruit Bitcoin miners to help fund utility grid growth.
I think there's actually a point to add on to that too. And so it's something that we've seen in the United States, but it's something that you're going to see globally as well. So when companies go and find, let's say a 30 megawatt area where there's a hydro dam in, let's say, a third world country, well, that third world country was never able to sell that power before. They had no one to buy it because they didn't have the transmission lines to actually bring the power to the local community or a nearby city. What we're seeing is all of the tax dollars and all of the revenue that's being generated from miners going to these locations is actually helping to pay for electrical infrastructure to actually build the transmission lines to local jurisdictions. And so that's something that we're seeing, we saw it locally happen here in the United States, but it's something that you're going to see in mass as more Bitcoin miners start to move globally. And so this is actually a huge net positive that Bitcoin is bringing to third world countries that is really unrecognized today. Because what other type of company can go in, take 30 megawatts, 50 megawatts, maybe it's 200 megawatts in a third world country? It's no one. No one can really show up and take that much power. It's Bitcoin miners that can actually do that, and the amount of revenue and tax dollars that are generated from it are so significant to a country like that, that it's providing them the opportunity to build out the electrical infrastructure, which everyone knows that power-rich countries are ones that end up being successful over the long term. And so allowing Bitcoin miners to come into jurisdictions where there's a lot of stranded power is net beneficial for that country over the long run. And it's something that you can look back through the history. Every country that was power-rich and was able to distribute that power across their country was able to be very successful over the long run. And so that's something that I think countries are starting to recognize today. And it's a long-term thesis for a number of countries to bring Bitcoin miners in. And that's why you're seeing all of these announcements across the globe for countries that you wouldn't necessarily expect to see it from. But they're saying, we're going to open our doors to miners because they're actually going to be able to provide a significant amount of value in a way where we've never been able to monetize what we have. And that's really power for a lot of these countries.
Yes, some of the examples of places, 2 years ago, everybody was talking about the Middle East. They have tons of power, tons of gas, tons of sun. But now, that's, I don't want to say saturated, but that's well known in the market. So folks have been deploying there pretty heavily. I don't know if Core has, but I know a lot of the big pubcos have. But now there's Ethiopia, there's Kenya, Paraguay. So there's places where there's big energy generation assets that were being effectively latent. They weren't being utilized. These are some of the places where miners are kind of flocking right now.
And then also, here in the U.S., we're also benefiting the grid here as well, because every place that we go and set up, they're able to refresh all of that infrastructure. They're able to lower prices for those that are near those power resources. And then in addition, we're able to stabilize the grid, because when there is high demand and we do that curtailment work that he's talking about, we're able to make the grid stay at the perfect level so that everyone has enough power and the lowest prices they can get.
Good answers, guys. So, Nick, I'm head of mining at Core Scientific, and literally a hot link on every device I have is the hash price index. And I'm teeing it up because I want to ask you about,
Okay.
You guys at Luxor created it, but then I want to ask Larry from an operational perspective and Adam as the CEO of a pubco, just hash price. What is it? Why do we use it? Why is it important to miners?
Yeah, so we built a website called Hash Rate Index. Originally, Hash Rate Index was designed to display one thing, and it was a chart of what we call hash price. Hash price is the value of a petahash per second per day over time. Changes. There are several variables that go into it. The number one, of course, being Bitcoin price. Obviously, you've got network difficulty, transaction fees, and then the Coinbase subsidy, which changes every 4 years. We started to realize like the value of mining changes every day based on transaction fees or Bitcoin price, and I wanted to display that. How can we display like that change in value over time? And that's when we started to come up with this term called hash price. And so hashrateindex.com, we just displayed, all it was a single metric, and it was hash price over time. Generally trends down because machines get more and more efficient. Sorry guys, it does trend down. That's just the way it is, but it trends down. But today I think it's about $55 per petahash per second per day. A couple years ago, it was in the $400 to $500 range, right after the Chinese mining ban. But we just wanted to be able to capture that. Now Hash Rate Index, we do all sorts of stuff like machine reviews, and we display network difficulty and all sorts of different metrics there. But that was like the concept. It was about 4 years ago when we started that metric, and now it's become the industry standard for the value of hash rate. And we even have tradable products. We have a Bitcoin hash price future that's listed on Bitnomial that trades and allows miners the opportunity to reduce their risk, take some chips off the table, and then also give folks some upside if they're looking to buy hash price at a certain level. Larry, on to you.
I think hash price is one of the most valuable pieces of information that we put in front of our ops teams. We have all of these variables that we look at, whether it's it's a weather or it's the power price, or we're looking at the Bitcoin price. In each of these scenarios, all of this has to be rolled up into the tooling so that we can make real-time decisions about when do we want to curtail, when do we want to enhance our hash rate, when do we want to make it more efficient, which particular units should we be optimizing at any given time, which particular sites should we be changing the power profile at. When you look at the heads-up display of all the important variables, it's one of the significant pieces, and certainly another thing about this era is we didn't have that before, like you said. And when you go back to the previous time, we had to do all of that ourselves, and we had to figure out that piece of information. And for our ops teams, again, we live and breathe that number.
So I actually am a hash price convert, because when Nick first introduced it, I was on a call with him and Ethan, his other co-founder, and I was like, I don't like it. I like revenue per kilowatt hour. For me, it was revenue per kilowatt hour, something where it was very directly relatable to price per kilowatt hour on the power side. Over time, the industry has really adopted hash price as the most common metric for how to measure profitability for mining. And that's something where we've had to introduce cash-based hash cost, or just hash cost. It's essentially what is our cost basis spread across on a per terahash basis. And so that's something where we can directly relate that to hash price. And going forward, that's really how we're actually able to recognize what our cash margin is at any given point in time on a daily basis, on a minute-by-minute basis inside of our firm, because we're actually able to determine how do we maximize the profitability of our machine. So how do we set the firmware to ensure that we're maximizing profitability based on hash price? Now, the interesting part about hash price that, if you look back over time, as Nick mentioned, you see it declining, but hash price is going to have increased volatility as we start to, I would say, level off at certain levels. And that's mainly going to be driven by the fact that transaction fee volatility is going to increase. And so when you think about the variables that go into hash price, right, it's block subsidy, it's transaction fees, it's network difficulty. It's essentially, how difficult is it to mine a Bitcoin at any given point? And over time, as transaction fees become a larger part of the block subsidy, or as a percentage of block subsidy, that's actually going to increase the volatility of hash price. Even though we might be around a more centralized band, on a percentage basis, you're actually going to see it vary, I would say, on a 30-minute basis or an hour basis, as new products are introduced that use, fill up the mempool, create higher transaction fees. And so that's something that we track hash price very closely. We use it for our forecasting internally, And it's actually an incredibly important metric for miners that are entering the space to actually recognize if you're spreading your cost basis across on a hash basis, what does your actual margin profile look like? And it's something that I think is going to continue to get utilized, especially as folks like Luxor have introduced products to trade around hash price, to hedge hash price on a forward-looking basis. Those are all really important items for Bitcoin miners going forward as we look to stabilize our business, especially stabilize around increased volatility of hash price going forward.
So yeah, a lot of miners really want to be able to measure revenue per kilowatt hour. But the reason that is less ubiquitous is because it's not universal per miner. Every mining machine has a different revenue per kilowatt hour number, and that's because the efficiency of each machine is slightly different. So that means the revenue per kilowatt hour at CoreSci is different than the revenue per kilowatt hour at Cypher or Bitfarms or whoever that happens to be. And so that's probably the reason it didn't catch on. Every miner has its own revenue per kilowatt hour number, but they have to calculate that themselves because they're the only ones that know, exactly what their their efficiency mix is. And so that's probably that is the reason why it's not as ubiquitous.
Yeah, and the reason I asked that question is for those that are not miners in the audience. So I'm head of mining at Core Scientific, and our network we've mined 60 or 70 or 80,000 Bitcoin the past 2 or 3 years, I guess, for us or other people. But other than Danny, who's our head trader here, most people at Core don't pay attention to the price of Bitcoin, whereas retail users, they really pay attention to the price of Bitcoin. If you're a miner, it's hash price, it's how efficient are you, because it's not just the price of Bitcoin that goes into your productivity, but it's that network difficulty that's there, and it's also those transaction fees. And I think they made some really good comments there on the volatility of transactions fees, because it's those days where you have a lot of transactions fees that you peak. That's really where you pay for everything. All right, so 2020 versus 2024. So I wanted to throw this out there and just give you guys the opportunity to talk about it, and then if we have a few minutes, we'll take some questions. But 2020 versus 2024, we had the halving in May of 20. We had it here a month ago, month ago, I guess, here in 2024. And I just want to throw it out there for you guys to talk about where we look at operations and where we look at fleet management as miners today versus how we did it, during the last halving. And then also, if you want to, take it out to 2028.
I'd like to take that one. The difference between these two eras, certainly it was a lot of sort of tying things together yourself. We had just come through, and received these ASICs. We were sort of patching them together and figuring out how best to operate them. And facilities were stood up where they weren't necessarily the ideal facilities for them, but we had to get these things up on shelves. And what has changed since then is we've all become more optimized, all the companies in this space. We've realized that the margins are getting tighter. It's very hard to get the most out of the equipment. And so there's nothing really that you can leave on the table. Everything has to be tuned. We have to figure out how best to pack the machines. We have to figure out how best to operate them. We have to keep them operating longer without repair cycles and getting to the shelf. We have to see our way through all of the equipment operating for longer periods of time and having more and more equipment come in. And which equipment do we cycle out? Which equipment do we tune down? All of that is now on our minds. In 2020, margins were much higher. You could operate equipment that, as long as it ran, get it up on the shelf. Now we have to be very choosy. We have to be very careful about how we operate it and when we operate it.
So yeah, 100%. In 2020, it was more about keeping machines online. It was like, how do I keep the machines turned on? That's really all that mattered. That's what site operation really meant, was whether the machine was on and hashing or it was not. Now, it's much more complex. You're tuning individual machines. You're tuning a fleet of machines. You're looking at a data center more as a fleet of chips as opposed to individual atomic units. And that's definitely going to continue to be the case. There's a lot of folks that are working on machines that are supposed to be like heaters and commodity. Basically, Jack Dorsey says anything that produces heat should be Bitcoin mining, should have an ASIC in it. And if that's the case, those are the amount of tuning that's going to be necessary to optimize for each different operating environment is going to just continue to drastically increase.
Yeah, I mean, if you go back even prior to 2020, I mean, I was running miners in my apartment in New York, plugged into AC outlets, and that was something where, I heated my entire house, even in the winter, and I had all the windows open. But what we saw back then was, I was profitable at 17 cents per kilowatt hour power price. That's something where today, you can't just plug in a machine anywhere. You have to be very thoughtful about what are your power costs, what are the programs that you have to participate in. All of these different things actually come into play in a much bigger way. And so in 2020, as was mentioned, it's like, yeah, just unbox the machine as fast as possible and plug it in, and let's not try to burn this entire building down. Now it's like, all right, how do we optimize this exact model of machine for the weather variables, for the power, the different power programs that we participate in? How do we actually make this the most profitable machine we possibly can? That is the timeline of 6 years in terms of what we've seen, going from mining in homes, mining in small facilities, to now it's how do we make this the best possible and most profitable mining operation we can. And so that's a complete radical change that we've seen over time, because even in 2020, the majority of the machines were operated in China, and that's something where they were commodity boxes, they were treated as such, people were very rough with the machines. Now it's like, okay, well, we have to pack them correctly if we're moving them between facilities. We have to be very thoughtful about which facilities we're sending them to. And that's something that no one thought about in 2020. And so now we're in 2024. In 2028, that's going to look even more different. We're going to see many more smaller sites. We're going to see people be much more thoughtful about the tuning of their firmware, how that takes into account, you're going to be placing other pieces of hardware in your facility. It's going to be measuring pressure, wind, the prevailing temperature data. All of those things are going to actually come into play, and so you're going to see much more advanced mining facilities, even at a smaller scale, because that's what's going to be necessary to be profitable in 2028. And so just the timeline of 2020 to 2028, you're seeing a massive and radical shift and an improvement in efficiency. And that's not just the machine efficiency and how much that's going to improve over the next 4 years, but also at an operations level and at a technology level that represents a dramatic shift in this industry that I think if you go back to 2018 or 2016, no one would have really predicted that, because it was still the time period where it was just plug as many machines as you can and let's hope everything works out, to now we are in the most advanced era, going in 2024. In 2028, this is going to be one of the most efficient technology industries that you can see.
So we're actually below the time to do a Q&A, so I'm going to actually throw a question out there specifically. Oh, okay, we do have a question. If you got some room real quick, Abby, we'll answer fast. I know we're inside the 7-minute warning where you said you would kick me if I answered a question, but go ahead.
Appreciate the panel. John Carbone with General Electric Company. We manufacture electrons. This is a public policy question. Is a reporting requirement for mining agencies or mining operations to start reporting their energy consumption? What's the policy outlook or regulatory outlook for mining industry?
I only caught a bit of it. It sounded like you were asking about what are the reporting requirements for
energy consumption. Yeah.
Energy consumption.
Yeah.
Okay, Adam, I don't know.
Coming out of the Department of Energy this year.
Got it.
Yeah, so the question was mainly around, what are the reporting requirements? How do we think that could evolve over time? And so, from our perspective, all of the data in terms of what we consume, the power companies know that's all reported up to the highest levels, because our energy grid is also a national security item for the US government. So they already know what we consume. The power companies know what we consume. They can tell you what we consume on a daily basis. And so as we move forward in this industry, that's probably something that will become, I would say, more readily available. It's something that us as a public company, we actually give very good data points in terms of, how many megawatts we're consuming, how much intermittency we're actually taking to participate in different types of programs. And I think that's something that's going to become more industry standard. It's something that we've given to the public for years, and something that we think is going to actually push more people to have, I would say, tell the market what they're participating in from a power program perspective, how many down hours are they experiencing to actually give power back to the grid. Those are all important variables going forward, and the outlook on that is more transparency, the better. And so I don't think it's necessarily going to be driven by policies. I think it's going to be driven by the good actors in this industry that want to tell the market exactly what we're doing, how we're helping local grids, how we're actually helping support local communities when there are power shortages. And so I don't know if it's necessarily going to be policy driven. I think this is going to be something that's industry driven to drive more transparency into the actual good that we provide to the grid.
I think transparency and predictability. We provide a stabilizing force for the grid, and we work very closely with them, and we commit to providing them the exact amount of power demand that they need in order to keep everything stable. And so I think there's a tremendous amount of transparency, but also it's all planned out. They know exactly what they want us to use, and we meet those commitments.
Have time for one more? No. Okay, one more question. Right here.
Thank you, Sean Foster.
Hold it right up to your mouth.
Oh, right up. Can you hear me now?
Yeah.
So I heard you talk about, you put get your machines on the shelf and the optimization cycle that we're in now. Why hasn't immersion cooling come on the table very strong, since it cuts out a lot of the ambient cooling needs within your data center?
I think immersion cooling is one of the options. There's a variety of ways to dissipate the heat, and it really depends on the facility. It depends on the available supply chain of the components. It depends on your ability to maintain the dielectric fluid at a particular location. The concerns that come from operating that, they fit certain models in different places, and really we have to evaluate that per site and per machine. And so in some cases, it's the exact right solution. And in other cases, it might be an enhancement. And we think about sort of the cost that goes into it, but more or less, the quality of the machine, the quality of the location, all of that will dictate, in a perfect matrix, what is the right solution for that.
Yeah, immersion is also quite a bit more expensive. Generally, folks, you're in the $1 million range per megawatt to build immersion systems, where air-cooled is probably going to be more in the $300,000 to $400,000 per megawatt range. Obviously, very, very generally. So it's quite a bit more expensive. But there are things, like Larry was mentioning, that you can only do in immersion. For example, some of the most aggressive curtailment strategies require immersion because you can't have, it would degrade the machines too quickly. So there are times where you absolutely have to have immersion or some sort of more advanced cooling system like that. But yeah, immersion is definitely a technology, as you mentioned, that's going to be a site-by-site and case-by-case basis requirement. Generally, you wouldn't want to do immersion unless you have to.
Audience, thank you. Guys, thank you. Appreciate you joining me up here.
Yeah, thank you guys.
Thanks all.
Appreciate
Thank you,
it.
everybody.